Everyone wants infrastructure debt, but it is actually hard to get. Pension funds and insurance companies typically chase three things: stability, duration, and diversification. And infrastructure debt can tick all three boxes. Infrastructure debt can be seen as quite an attractive asset class in a volatile world that we live in. Why? Because these assets are essential. You will have road, power, water. These assets are not going away. They'll still be there tomorrow. They will be there in a recession. But here's the thing. For institutional investor to access this asset class, it's not that easy. Let me explain. Firstly, infrastructure is a very complex asset class. Every single asset is unique. You need to do detailed due diligence, environmental, technical, social due diligence that you have to do. Construction periods are different. It takes a very long time to actually put an infrastructure project together. And hence, it's complex to actually participate. This is not the typical corporate bond that you would buy as an institutional investor. Second, it's hard to source them. These loans are not traded on a Bloomberg terminal, but actually 70 to 75% of infrastructure debt is in loan format. And hence, it's tucked away on some balance sheet on corporate banks in Jakarta, Singapore, Indonesia. And hence, unless you participate in the syndicated loan market, it's not that easy to actually get access to it. So what does it mean? It means the demand is there and the attraction of this asset class, but access is not that easy. And here's a wider picture. Asia needs 1.7 trillion of infrastructure investment every single year. And let's put that number into perspective. That's about the size of the Australian economy. Or put it differently, you would have to spend $55,000 every single second for a whole year to get to that number. And where are we right now? At the moment, there's a shortfall of about 819 billion, so we barely cover half of it. And that's what we refer to the infrastructure funding gap. If this pace continues, the infrastructure gap will not narrow. It will actually entrench inequality, constrain growth, and defer sustainability targets. So where is the capital? Well, governments certainly have big ambitions, but limited fiscal space. Banks know how to lend, but they have regulatory constraints, especially for long-dated infrastructure loans. Capital markets benefit from a deep pool of capital, but for them, infrastructure is complex, unfamiliar, and illiquid. So the problem is not really the lack of capital. It's more, how do you channel the capital into infrastructure? Because even though trillions of dollars sit on the global capital markets, little money or too little money reaches our economies and funds infrastructure that we need. And the only way to actually bridge that gap is to focus on smarter and more innovative ways to attract the money that we already have. So unless it is easier for institutional investors to participate, private capital mobilization will be stuck in theory, and the money that we need would go somewhere else, rather than transforming Asia. So what if we could change that? What if we could take infrastructure loans, bundle them, rate them, and make them transferable? What if investors could participate in a diversified pool of infrastructure loans and choose what kind of risk and reward profile they want to take in this portfolio? What if the next solar plant is not a complex, unique project that needs to be analyzed separately, but it's part of a portfolio, a line item in a portfolio that is diversified and that can be purchased and sold? So at this stage, let me introduce securitization. Securitization is a financial technique and method that is established, and capital markets are well aware of how it works for other asset classes. For infrastructure, we call it infrastructure asset-backed securities, or in short, IABS. It allows to transform illiquid loans into rated transferable securities. It allows pension funds and insurers to gain diversified exposure to infrastructure without underwriting each and every single project individually. And crucially, it gives banks the ability to sell down exposure, free up their balance sheet, and enable new lending into infrastructure. At AIIB, we were not only supporting this model and this instrument, we had the privilege to be part of this journey. AIIB invested 30% in Bayfront Infrastructure Management, Asia's first platform that focused on infrastructure loan securitization. We embedded MDB-level environmental and social safeguards into the process, raising the standard for each and every loan that goes into these portfolios. And when there was an issuance, we provided an anchor order. We wanted to signal, this is investable, this is a solution to the problem. And here's how it works. So first, banks issue loans in their normal course of business to infrastructure projects. Solar farms, toll roads, digital towers spread across Asia, Middle East, and Africa. Second, the CLO manager, Bayfront, is reviewing the loans and buys them from banks and groups them into portfolio. Third, portfolios are then sold into an AIIBS vehicle, a standalone entity. And lastly, the vehicle issues notes, transferable investable notes that are backed by infrastructure loans. The notes will be split into tranches. So what are the tranches? So that part is key. You have the tranches are effectively slices of the portfolio, and the most senior one is the safest one because it's backed by the entire pool of loans. It gets paid first, and therefore the return is slightly lower. Next, the mezzanine tranche would be paid, and that's a little bit more risky, and hence the return are slightly higher. And lastly, we've got the junior equity investor who takes the highest risk and also gets higher returns. But it also takes the first loss if there's any losses in this portfolio. So this tiered structure lets investors choose the level of risk that they want to have and their appetite, whether they want safe, steady returns, or higher yields or more risk. And before any loan enters into this structure, there are multiple levels of safeguards. The bank is underwriting the loan when they issue it, and they keep typically a portion of it. Then there's a CLO manager, Bayfront. They are reviewing the loan and doing detailed due diligence, environmental and social due diligence when they buy it from the bank. There's a rating agency that actually looks at each and every loan before they can issue a rating of the notes. And last but not least, Bayfront, the CLO manager, or Clifford Capital, the parent, is holding a portion in the most junior tranche. And hence, if there's losses, they would suffer as well. And this is how trust is built into this structure. So what kind of rating can you expect for this type of transaction? And I wanted to do a little bit of a thought experiment. Let's think we take two assets. And we have a wind farm in India, and we have a tower project in Brazil. Let's think about what do these assets have in common. They have different off-takers, they use different technology, they operate in different economies, they are on different continents, actually. They are underwritten by different banks. They don't have much in common, effectively. And this is an example of two uncorrelated assets. And this is what makes this asset class and these portfolios so attractive, because if you had problem with one asset, let's say a technology problem in the wind farm, it wouldn't increase the probability of default of the other project. Or if one off-taker defaults in one country, it doesn't have an impact on the other asset. And that's the definition of uncorrelated assets. Now, think not about two assets in two sectors in two countries. Think of 15 different countries, 13 different sectors with 34 different assets. So that's the type of diversification that you can get in these type of portfolios that are being securitized by Bayfront. And that's what makes this asset class so unique of uncorrelated assets, and that helps actually get such a high rating. So 70 to 75% of a portfolio are rated AAA. So what is the result of this? We have achieved to take illiquid, complex assets, and we transform them into transferable notes that can be purchased by institutional investors and participate into infrastructure debt. And finally, as a result, the pension fund in Europe, the asset manager in Middle East, and the Korean life insurer, they can put their money to work into infrastructure debt. But we didn't stop there. We thought about another question. And we thought, what about if one of these tranches is not about just risk and return, but it's also about resilience, about renewable energy, and about reaching underserved communities. So this is where the sustainability tranche of this transaction comes in. And effectively, the sustainability tranche is cutting or slicing another tranche that is exclusively backed by social and green assets. It follows a use of proceeds principles, just like any green bond that you can buy as well. And it's applied here to securitization. The dedicated sustainability tranche helps investors to actually get a direct way to get exposure to sustainable assets, sustainable infrastructure that AIIB is focusing on. So to supercharge this innovation, AIIB launched a project Merlion. And Project Merlion is not a one-time investment, it's a 350 million program over time, where we invest exclusively in sustainability tranches that are being issued by Bayfront. We think of it more not just as capital, but also a catalyst, because we wanted to send a signal to show this is where we want to focus on sustainable assets and sustainable infrastructure. And it should send a signal to the market, but also to Bayfront, that there's an exit for this asset class or for this particular tranche, to source more assets and to increase the number and the amount of sustainable assets in these portfolios. If there's more demand than what is required from us, we would basically scale back our order accordingly. So, and this is what else is compelling about this structure. The sustainability tranche also follows international standards like ICMA, the International Capital Market Association. It has a second-party opinion provider, so it ensures that the asset that are backing the sustainability tranche follows Bayfront's sustainability framework. And it brings real accountability, and this is important. There's an impact reporting on what is being financed with these assets. Greenhouse gas emission avoided, renewable energy capacity delivered, people and communities reached. Hence, in other words, we are investing in the sustainability tranche is not just investing in projects, but it's impact investing with accountability and reporting. To sum up, with AIIBS, a model has been created to achieve private capital mobilization for sustainable infrastructure, in particular with the sustainability tranche. So, tremendous progress has been made since this was initiated. Bayfront annual issuance used to be around 400 million. This year, we hope that we can get to up to 1 billion, so the volume has increased tremendously. The share of sustainable assets in each of these portfolios has increased as well over time. The oversubscription by investors has increased, and the amount of coupon or interest that needs to be paid in order to transfer that risk to investors has decreased. And that shows that, that investors become more and more comfortable with this asset class. Banks are recycling their capital faster because they have a way to de-lever and de-risk their balance sheet, enabling new lending into infrastructure. And investors have finally an easier way to actually participate in infrastructure debt. But despite all this progress and despite this tremendous development, the infrastructure asset-backed security market remains tiny at this point in time. Yes, we have proven the concept, and yes, we have seen successful issuances, and we've shown that income and impact can go hand in hand, but the potential of this product and this instrument is still enormous and not tapped. So we see it as a gateway between institutional capital and real-world infrastructure, between financial markets and sustainable development. And at the moment, we are just scratching the surface. So let's not treat this as the end of the story. Let's treat this as chapter 1. Thank you very much for listening. And next, we will have a fireside chat here on the stage with Niklas Tan, Niklas is the head of markets and investor services at Clifford Capital Group, and he's a CEO and executive director of Bayfront. Niklas, thank you first for being here, and congratulations, I think, on behalf of the AIIB team as well for the tremendous track record that you've set with establishing infrastructure asset-backed securities as an asset class for infrastructure investment. I think, as I mentioned, the progress has been tremendous, and it has been fantastic to partner with you and the whole entire team. Given that you were involved from the very beginning of structuring, of distribution, and setting it up, it would be interesting to hear what were the key milestones that you went through, what were the challenges, but also what role did AIIB play within that process?
Sure, thanks Torsten. Thanks for having me here, and also the luxury of having a chair to sit on instead of having to stand for quite a bit. So for those that are not familiar with Bayfront Infrastructure and also the Clifford Capital Group, we're part of the Clifford Capital Group that is a portfolio company of Temasek Holdings from Singapore. We are a platform that focuses on the origination, distribution, and management of infrastructure credit globally. So the Bayfront Infrastructure platform is really our warehousing and securitization part of the business, which is part of the broader markets and investor services business that I run at Clifford Capital. So to address your questions, yes, I would say that the journey over the last 8 years since our first pilot issuance back in 2018 has been very gratifying. We were very privileged to have the AIIB as a strategic partner with us along this journey. AIIB, as Torsten alluded to during his initial presentation, has a 30% equity stake in our Bayfront warehouse platform. That, together with the support from the Singapore government through a sovereign guarantee of $2 billion, allows us to create a warehouse balance sheet in order for us to accumulate these infrastructure loans before we securitize them. That's important because when we engage with individual banks, we need to have a ready capital pool in order to deploy immediately. Banks would not be sitting around to wait for us to structure a securitization, which tends to, the process itself tends to take anywhere between kind of 3 to 6 months before we're able to put together a sufficiently diversified portfolio that you have seen Torsten presented earlier. So it's important to have that warehouse balance sheet there in order to interface with our bank partners in order to accumulate those assets. AIIB's role has obviously evolved together with us, as Torsten alluded to, apart from being a strategic partner with us at the platform level, helping us initially in relation to how we look at our ESG policies, subsequently how we develop our own climate strategy, but has also been a very consistent anchor investor for us for our issuances. In the earlier years, when we were just starting out back in 2020, 2021, 2022, especially when we were going through the whole COVID period where spreads for capital market products, especially CLOs and ABSs were particularly wide. Introducing a new asset class at that point in time and then trying to scale up was obviously pretty challenging, right? And at that point in time, as you can imagine, if you kind of circle back 4, 5, 6, 7 years ago, interest globally in infrastructure credit is not necessarily there. I think today, the sentiments are obviously different, with many of the financial sponsors having raised billions and trillions of dollars to invest in infrastructure equity. That would necessarily also translate into a lot of opportunities for us and interest from global investors into infrastructure. But in the earlier years, we obviously were very fortunate to have AIIB support us, validating the product, given the fact that AIIB is an Asia PAC and infrastructure focused MDB. That helped us validate the robustness of the structure, robustness of the product, and also the credit profile of the underlying. So that was quite important in terms of positioning the product to global investors. So especially during the first couple of issuances, and also validating the pricing that we were issuing into the market, because there were very little comparables today, but even less so at that point in time. So both in terms of credit profile, structure, as well as pricing, those were very important validations that AIIB offered as an anchor investor in the earlier years of our establishment and the earlier couple of issuances. Today, as Thorsten alluded to with Project Merlion, the focus has shifted a little bit. As you can imagine, as the platform and product matures, our relationship and collaboration with the AIIB has to evolve as well, and we expect to continue evolving into more innovative solutions going forward. Sustainability tranche was something that we pioneered back in 2021, I think, with our BIC2 issuance. Again, that was something new. Thorsten alluded to the fact that the AIIB standards do cover this as a product. I think it's now called the Secured Sustainability Standard Bond. Back when we first pioneered this product, there was no such label. Right? It came, I think, towards the tail end of 2022. That was published by AIIB, validating obviously the structure. But when we first introduced that to the market, there was no such label specifically for a sustainability tranche sitting within a securitization structure. So that was something that was helpful, and with AIIB's assistance, I think we were able to obviously bring credence to the product. And in the current global environment where I think global investors are finding it somewhat stepping back, I think, in relation to their focus on green and sustainability, having AIIB there to anchor our sustainable tranches, I think is also very, very helpful, even in the current context. Today, with AIIB support, and obviously the support of our bank partners, we now have about 36 bank partners on our MOU panel, and of course our investor base. We are one of the global leaders in infrastructure ABS issuances, with cumulative volume of issuances close to $3 billion. We've closed 6 public issuances to date since 2018, and a couple of private placements as well. We started in 2018 with, I think, only about 15, 16 investors. Today, we have about 70 investors that are invested across the vintages. Our last transaction was about $527 million in size, with about 40 investors in the book. So certainly the interest and demand for the product has increased substantially. As Thorsten alluded to, we've also been correspondingly increasing the ticket sizes, transaction sizes of our issuances, and together with that, the size of the sustainable pool of assets and sustainable tranche.
Very good. You already answered all the questions. But just one, maybe it's interesting because we look at it obviously from a private capital mobilization, raising more investors or having more investors participating in these kind of transactions. is obviously very important for us. How do you see that evolving? Like if you once you at the beginning when you had the first or second one, you obviously people probably spend a lot of time. Is it becoming more established? Are people becoming more comfortable with the inbuilt trust that we have? Because you, I mean, as I alluded, you have rating agencies, you hold the equity piece, there's a bank who underwrote these assets. Are people becoming more comfortable with that whole mechanism, or do they still, I mean, we obviously don't want to suggest that you don't have to do the credit work.
Yeah, the track record definitely helps. I mean, with our almost $3 billion of issuances to date, we are proud to say that we have a 0% payment default rate that we can speak to. Of course, I think even when we talk to investors, they were quite interested to understand in cases of default, how would we approach workout. So having a 0% track record is not necessarily always the best thing, but I think within the group, we have a direct lending business as well, and within that, obviously, we have a couple of default situations over the last 13 years of our existence, which we can speak to, right? So it was helpful to be able to quote some of these war stories, and also then point to the fact that what we drop down into our securitization product tends to be on the safer end of the spectrum, and these are already operational assets, and hence tends to be already de-risked. So that I think gave investors comfort that number one, we had the ability to robustly credit underwrite, select the right profile of transactions, and also have the right kind of alignment of interest when it comes to including loans into our securitizations. And when it comes to, if ultimately it comes to the point where we have to deal with restructurings and workouts, we have the experience and the capability to do so. I think those were important. Those are important points that, as part of every conversation that we have with investors, they will always query about our credit underwriting process standards and also how we look at dealing with a defaulted type of situation. But certainly, like I said, the track record helps because when we first started, we had to obviously point to more generic studies. Moody's, for example, has a default and recovery study that in our earlier issuances we constantly kind of point to, showing that there is low default rates, high recoveries, especially for operational infrastructure assets that we're lending into. But of course, those are all study-based and in a way quite theoretical and not necessarily reflecting our own performance because we just started out, right? So it's helpful to be able to show that over the course of the last 7 years, all of that have kind of panned out the way it is. In fact, our performance has been better than what the overall market experience is. So that was a good way to reference what the thesis that we have portrayed to investors from day one. But I would say that investors continue, obviously, either because of their own internal diligence requirements or because of regulations. If you're a regulated investor like an insurance company or bank treasury, you do need to follow certain diligence standards that are imposed by the different jurisdictions. So some level of disclosure and diligence on the underlying is still required by investors, so we need to always be prepared to do that. And we have obviously the infrastructure in place to do that in a pretty efficient manner now.
Excellent. Maybe we spend 30 seconds on one last aspect, which is very important for us at AIIB, the share of sustainable assets and the size of the sustainability tranche. We obviously so far have seen that it has been growing over time, and we welcome that. We want to incentivize that. But we recognize as well, it's not always a one-way street, basically. So what are the dynamics? Maybe you can briefly talk about it, the sustainability tranche, how you see what is the market like for sustainable infrastructure debt that you acquire? What are the challenges? And also maybe your forecast in terms of not only sustainable, but your growth projection for this asset class.
Sure. I'll just very quickly touch on it. I realize the time is flashing red. For us as a firm, for every single asset that we look at, regardless whether is it sustainable or conventional or otherwise, it's through kind of three important high-level considerations, right? Credit, ESG, and returns. So every single asset has to pass muster across these three high-level considerations. Let's take renewables, for example. Obviously, we would like to do as many renewables transactions as possible and to increase our proportion of green and sustainable assets within our portfolio. We do get questions from time to time, why can't you just do a 100% sustainable issuance with all the tranches being sustainable instead of just one tranche? Diversification is one issue, right? We obviously need a large pool of assets from many different countries. Thorsten alluded to kind of 15 different countries, 13 different subsectors, in order for the securitization structure to work. I would say that beyond just focusing on the green social label, what we have done is also to pivot towards what we consider as new economy assets. So these are assets within the transportation space, digital infrastructure like data centers, telecom towers, fiber, broadband, and also logistics. And these are not necessarily asset classes that can be considered as green as part of the ICMA or any kind of sustainable standards, but we consider them as very important sectors to help economies develop. Right. So beyond the label, I think as a firm we have been kind of pivoting towards more of that and less of pure fossil fuel related type of transactions. Yeah. But yeah, we have to obviously balance the credit profile, the ESG risks and also returns. Renewables, for example, I think everybody sees it as green and hence it's all hunky-dory from an ESG perspective. But actually, if you look at climate risk, there is physical and transition risk. It may be low on transition risk, but physical risk is high because you are relying on the wind to blow. Maybe it's a little bit less of an issue for solar. But yes, there is still ESG involved. There's social biodiversity considerations. So all these are part and parcel of what we look at. On top of that, it's whether the credit stacks up. Because when you're looking at two power transactions, both have PPAs, but they may be different, right? A lot of the renewable PPAs are more take and pay rather than take or pay in the earlier format of fossil fuel related type of power generation. So all these are important for us to consider.
Excellent, thank you, Nicholas.
Very insightful sharing. And my question is regarding the deal structure design. So as Thorsten mentioned, so we acquire infrastructure loans from commercial banks. So have we considered incorporate revolving purchase mechanism to enhance transaction efficiency, alongside provide flexibility and liquidity for the senior tranche investor and the sustainable investors to attract, in the secondary market, to attract more participation from institutional investors? This is my question I want to raise. Appreciate your thoughts. Thank you.
Okay, if I kind of understand your questions correctly, a second question relates to how can we provide liquidity for investors to participate. I think for that, we do have quite an extensive group of market makers that helps us market the notes when we issue to investors. Our requirement for them to be our book runners is also for them to support the trading of notes in the aftermarket. And during the issuance period, they also then have the confidence to be able to provide financing for investors that are interested to lever up their positions, especially for our senior tranche. So for the kind of 4 or 5 banks that are actively book runners in our issuances, they do provide, for example, repo, TRS services for investors to be able to obtain leverage if they need to. Yeah, and they do have balance sheets that are dedicated to trading these notes in the aftermarket as well. Yeah. The first question was in relation to.
So how we incorporate revolving purchase mechanism to our current transaction structure, enhance transaction.
Yep. As I alluded to earlier, and Thorsten touched on this during his presentation as well, right? Almost every project is unique. So we go through a very thorough credit underwriting process, anywhere between 4 to 8 weeks. Look through every single project and financing document. If need be, we would obviously speak to the sponsors as well in order to understand if there were issues that happened before and were rectified, we also wanted to understand the background to that. So it's a pretty thorough process when it comes to underwriting, right? So we have to go through that. We sign MOUs with the banks to align understandings in relation to the type of transactions that we're looking for, eligibility criteria and all that, to try and smoothen the process. But for us to just enter into a mechanism whereby we automatically off-take transactions, it's not something that is aligned with how we look at credit underwriting. Hence, ultimately, we still have to look at every single deal that's being shown to us. But of course, we're happy to look at portfolios as well. We've done a number of portfolio acquisitions whereby banks would just show us a portfolio of 5, 6 different assets, and we look at them all together. And we can obviously then mix and match in terms of pricing and ratings profile and so on and so forth in the portfolio acquisition approach. So it's a little bit more efficient, but still we wouldn't compromise on the credit underwriting side of things. Yeah.
Yeah, and maybe the other aspect is if you want to have revolving structures where you replenish, I think that's the challenge there is a rating agency process to actually get that done, right? But anyway, I think it's a fascinating topic and we could go on and on and on, and we are over time. Thank you very much, Nicholas, for joining us here and sharing your insights. And thank you very much for being here. Let me conclude that infrastructure asset-backed securities for us is at the heart of AIIB's strategy because we can achieve private capital mobilization for sustainable infrastructure with innovations such as the sustainability tranche. And therefore, it's such an important instrument with a lot of potential to close the infrastructure funding gap. And this is what this bank is about as well. So we'll be around at the end, at the back of this room if there's any further question or discussion that you would like to have. But thank you so much for joining this session and listening to us.
Thank you.